Well, welcome back to Managerial Accounting, and the purpose of this little mini lecture is to review the multiple choice component of exam number 2. So you're going to see a couple of things written on your first page of your exam booklet. First is the number of questions, and there were 32. So number of questions you got right divided by 32, and then I would have multiplied that by 50 points, and that would have been the total number of points you got on the multiple choice. And to that, I added your points you earned for the take-home part, questions 1, 2, 3, 4, and 5, which were all worth 10 points each. So to get your grade, you take your percentage you got correct, the percentage of the 50 points that you got from the multiple choice, and you add it for the number of points you were awarded for each of the 5 take-home questions. So what I'm going to do here is I'm going to review the multiple choice part. I'll do a separate little mini lecture on the take-home part. And for the multiple choice part, you'll notice it's a combination of definitional type stuff. And if there's computations, I will show you what the computations were. Right? And there are 32 questions. So first one, AIRCO is tempted to consider support department costs to be used to be facility level costs that do not need to be applied to product. Which of the following shows that this is a misguided approach? What's misguided about this approach? Well, what's misguided is C. They make the assumption that product costs would be inaccurate because department services may be used more heavily by some products than others. So if you apply one blanket rate to all the different products, you're going to find that the amount of use by the support departments for each of the products might be very different. So the one that explains that why this approach is misguided would be item C. 2, joint costs are inseparable. I remember the story of Elmer the pig growing up in my relatives up there in New Hampshire. The joint costs are the costs before split off. So the costs incurred in raising Elmer before he came back is ham, sausage, and bacon. So the answer there, that's the definition of joint costs. Those are costs before split off. 3, which of the following are the 4 methods for allocating joint costs? The 4 methods of allocating joint costs are market value at split off, physical units, weighted average, and net realizable value. So the best answer there is C. Number 4, this one actually, I accepted 2 answers for this. Under the net realizable method of allocating joint costs, which of the following equations is used to determine the value of the products not processed beyond split off? So the most correct answer was C, but Cato helped me understand that if there were no additional processing costs, then A and C would be the same. So A would give you the same answer that C if there's no additional processing costs. So Cato, in your honor, I accepted both A and C. Number 5, which of the following is a drawback of using a single plant-wide rate applied to product costs using a single plant-wide rate? Well, a single driver is used to allocate all of the costs, and that may be unlikely that driver is appropriate for every type of overhead. So, the driver for cafeteria and janitorial might be very different. So the answer there would be B. Number 6, which of the following explains why it is difficult to apply support department costs such as janitorial costs to products? So the biggest challenge is to find the most appropriate cost drivers. So the answer there is C. So which of the following explains why it is difficult to apply support department costs to products? So finding drivers can be a challenge. So the answer there is C. Number 7, Woodbridge Incorporated manufactures food-grade wax-lined paper takeout containers for food service industry for many restaurants. Which of the following is most likely a support department cost within Woodbridge? So if you're making containers, then the deli container department, the sandwich container department, and the salad container department are all different production departments. So the one that would most likely be a support department cost in that context is B, janitorial. Number 8, which of the following statements is true about sequential method of allocating support department costs? Well, the sequential method, you start by capturing, you capture some of the interdepartmental support costs. You start with the biggest support department, and then you allocate it to the production departments and the support departments, and then you keep allocating the support department costs So the sequential method captures some, but not all. That's the correct answer. So all department by allocating support department costs to other support departments and production departments in a series of steps. So it's not the step, but it's sometimes called the step down method, not the step up method. So A is wrong. Sequential method requires the same cost driver used for each department. That's not true. Sequential method is less accurate than direct method. No, it's more accurate. So both by process of elimination and by the statement itself, the correct answer there is B. Sequential method catches some, but not all, inter-support department services by allocating support department to other support departments and production department in a series of steps. So the answer there is B. 9. Most operating decisions of management focus on a range of activities, and that is known as the relevant range. So you go below or above that relevant range, then the assumptions you make about variable costs and fixed costs are no longer valid. So that range is called the relevant range. Number 10, the point where profit line intersects in the horizontal axis on the profit volume chart represents the break-even point. So break-even point is where the costs, the horizontal axis, where the point where we intersect the profit indicates point where the profit. So we got, this is a volume profit chart. So the break-even point would be the point where you're actually going from the loss into the profit mode. So the correct answer there is D, the break-even point. Number 11, Piper Technologies fixed costs are $1,500,000, selling price is $250,000, and variable cost is $130,000. The amount of sales required to realize an operating profit of $200,000. So here you're using the targeted profit formula. So you take the fixed cost, you add that to the profit, divide by the contribution per unit, and you get 14,167, which is the answer is A. 12, which of the following would be classified as a fixed cost for a t-shirt manufacturer? So if you're making t-shirts, electricity, hourly wages, and cotton cloth are all variable costs. So the one that is fixed is none of them. They're all variable costs. So the answer there is none of the above. 13, in a cost volume profit chart, the total cost begins, the total cost line begins at the fixed cost. So again, this is a cost volume profit chart. So the total cost line actually begins at the fixed costs, where it crosses the axis, the vertical axis. So the answer there is C. 14, which of the following conditions would cause the break-even point to increase? So if the unit, remember break-even is fixed cost divided by the contribution per unit. So if the unit variable cost increases, you've got less contribution per unit. So therefore, you're going to have an increase in the break-even point. So the answer there is D. 15, as production increases, the fixed cost per unit actually decreases as you produce. Because remember, fixed cost remains the same regardless of what volume is. So if you increase the volume, then the fixed cost per unit actually decreases. So the answer is B. 16, which of the following is an example of a cost that stays the same as the number of units produced changes? Well, those would be fixed costs and electricity, direct materials, and wages. Those would all be examples of variable costs. So the one that would be fixed costs would be straight line depreciation of factory equipment. You could have depreciation being a variable cost if you use the units of production as opposed to straight line methods of depreciation. You may remember units of production from your Financial Accounting 1 course, often used in manufacturing. 17, which of the following is a reason for easy identification and control of variable manufacturing costs under the variable costing method? So all of those things are true when you use the variable costing. Fixed and variable costs are reported separately. Variable costs can be controllable by operating management. And fixed costs such as property and insurance are normally responsibility of a higher management, not operating management. So all those are, which of the following, those are all true for the identification and control of variable manufacturing costs. So the answer there is D. 18, contribution margin ratio is computed as contribution margin divided by sales. That's the definition of the contribution margin ratio. The answer there is B. 19, the amount of income under absorption costing will equal the amount of income under variable costing when the number of units sold, when the units manufactured equals the number of units sold. So if you have a difference, if you have an increase in production, If you produce more than you sell, or you sell more than you produce, those two methods will give you different answers. But if the inventory remains the same, there's no change in the inventory, i.e. when the number of units sold is equal to the number of units manufactured, your net income is going to be the same under both absorption and variable. So the correct answer there is B. 20. Under variable costing, which of the following costs would be included in the finished goods inventory? Well, finished goods inventory under variable costing would only include variable costs and wages of the machine operator, steel costs for a machine tool manufacturer, electricity used by factory machinery. Those are all examples of variable costs, so they all would be included under variable costing. It would be the fixed cost that would be excluded. None of those are fixed costs. 21, the amount of income under absorption costing will be more than the amount of the income under variable costing when the units manufactured actually is larger than units sold. So the answer there is A. On variable costing income statement, you did one of these in part of the take-home. The figure representing the difference between manufacturing margin and contribution margin. Those are the variable selling and administrative expenses. So the answer there is B. 25, which of the following would be appropriate activity for cost basis in a service firm? Which of the following would be an inappropriate activity? So inappropriate activity. Remember, a service firm does not manufacture a product. Lawn mowing, customers served, haircuts given, those could all be appropriate for service organizations, but service organizations don't produce inventory. So the one that would be inappropriate would be inventory produced, B. Which of the following is required by generally accepted accounting principles? Absorption costing is required by GAAP. So variable costing is used for internal decision-making. Remember, the whole purpose of this course is to prepare specialized reports to help management make decisions. But we have to answer to a higher authority when we do our generally accepted accounting principle-based financial statements. And GAAP requires absorption costing to be used. So the answer is A. Sorry for the cough. Number 25. PD company is trying to decide how many units of merchandise inventory to produce each month. The policy is to have 20% of the next month's inventory in inventory at the end of each month. Product sales for August, September, and October are as follows, and they want to know the number of units to be produced in September. So in September, we want to have 20,000 units because that's the number of units we're going to sell. Plus, we want to add that to the ending inventory, and the ending inventory is supposed to be 20% of the following a month's needs, so 20.20 times 0.40 minus the beginning inventory, which again is 20% of the inventory from the previous month. So for the month, the number of units to be produced in September would be 20,000 plus 0.20 times 40 minus 0.20 times 20, or 24,000. 26, for the month of March, revenue is 1 million, sales commissions are 5% of sales, manager's salary is 80,000, advertising expenses are 65, and shipping expenses are 1% of sales. Miscellaneous and selling expenses are $2,100 plus 1% of sales. The total selling expenses, well, the total selling expenses would be $50,000, okay, which is 5% of the million, plus the manager's salary of 80, plus the advertising expenses of 65, plus 1% of sales, plus the $2,100, plus again 1% of sales. So your answer there is $217,100. The answer there is A. 27. The company is preparing its cash budget. The balance for January 1 is $290,000 and has a minimum cash requirement of $340,000. Following data is provided, so they want us to focus in on January. They say the amount of deficiency or excess cash after considering the minimum balance for January would be what? So beginning balance of January is $290,000. There's your receipts for January. There's your past payments for January. That gives you $366,000. And we want to have at least $340,000 on hand. So we've got excess cash of $26,700. So the answer there is A. 28. Which of the following is an integrated set of operating and financial budgets for a period of time? That's by definition, the master budget is the combined operating budget and the financial budget. It's called the master budget. So the answer there is A. 29, a disadvantage of static budgets. They do not allow for possible changes in activity levels. That's the downside of a static budget. So the answer there is C. 30, which of the following estimates the number of units to be manufactured to meet budgeted sales and desired inventory levels? That's called the production budget. So the answer there is C. 31, which of the following which should be ignored when preparing a cash budget? Well, depreciation expense is a non-cash expense, so we would ignore depreciation expense. And 32, the primary budget in a non-manufacturing business would be the staffing budget. Staffing budget would be the primary budget for a non-manufacturing business or a service organization. Okay, so that's it for the review of the multiple choice. I'll do a separate little mini lecture on the take-home part. And until next time, adios, au revoir, hasta luego. I hope you found that review of the correct answers useful. Be well, everybody. Talk to you soon.